It's being called the Great Fall of China. Today, the Shanghai stock market slumped more than 8%. It's down 2/5 in 2 months. The jitters spread to the UK as London woke up. Shares dropped nearly 5%. Wall Street in the US took fright, then steadied a little to stand 1.5% lower. All from worries that the growth rate of Chinese manufacturing has faltered, an alarm that the Chinese government's attempts to stop the selling have failed.
The government believes they have a significant amount of control over China's economy. And to a certain extent, they even believe they can control the price of a stock. But you cannot, artificially manipulate market prices.
In New York and other financial centres, the value of companies connected with oil, metals and other commodities has plummeted. Traders fear that China won't need to buy so much.
Right now, there's fear pushing it one way. It's the global demand problem. And China is the engine of global demand. But China, we're not sure how fast their economy is growing right now.
Anyone who owns shares could lose out, including people who want to cash in their pensions and find they're not worth so much. On the other hand, drivers could benefit, the economic worries helping to push down the price of fuel. And home buyers could find that the cost of mortgages stays lower for longer if the Bank of England is prompted by the uncertainty to put off a much anticipated rise in interest rates.
Well, the consensus at the moment is that interest rates in the UK will rise probably in the first half of next year. And if anything, it will push interest rate rises out further into the future, say into the second half of 2016.
The UK economy is still driving ahead. Today, the employers' organisation, the CBI, raised its forecast for growth. Some say petrol and diesel prices could soon drop below £1 a litre, and that will help. Simon Gompertz, BBC News.